Welcome back to Dadvestor, where we are growing a small account from 2,000 to 10,000. But really the goal is 100,000, because after that, you don't really have to work on it. You just need to throw it into dividend investments and it's going to blow up. That is the theory. I have more evidence coming in a bigger video. This is just a quick portfolio update. I'm doing something different. Why? Because the market has been weird. And we had a huge melt up, so I closed a lot of my Iron Condors. And I shouldn't have. I shouldn't have closed the King Mechanics because they were wide enough and long-term enough to where the market might have dropped down. But at the same time, SPY is coming back up. Geez, where did it go? I don't have many positions opening. So, it came back up to 501, so maybe it was a good idea for me to get out of there. Right now, I still have a few puts. I'm just going to run the same mechanics on put spreads instead of Iron Condors and just leave the top half open. And if you look at back tests, selling puts underneath the SPY is more profitable. I think than any other trade, so even more profitable than buy and hold. So anyway, why am I up 157 in one day? Well, I've switched to a naked put strategy. I hate to call it that, but that's what it's called, where you sell a put and you don't buy any protection. So it's basically a undefined risk play. The reason why I did that is because it's the original strategy for the wheel. If you lose, right? So I'll show you on this one here. So this is a 91 percentile. Probably just let it. So this is a sell. So it's a full sell with no bottom. So you can see it's $2 profit right now. Well, when I did it, it was $34. So I have a return a total of $31. Now I'm just going to show you the position here, but the profit is actually whatever I just said, 34, whatever. Anyway, the point is, this is undefined risk. Actually, it is defined, isn't it? It's only undefined if it's an uncovered call. So anyway, essentially you put in the max loss, and that is, at the time I did it, whatever the price of 100 shares of the stock is. So essentially I found a very high volatility, relatively stable, cheap stock, right? So SPWR is a SunPower stock, and it's worth, right now it's $4.28. So 100 of that is $428. And I didn't put in that much because the other side of the trade put in the rest. So anyway, I could explain more about that later, but it's basically how puts work. You sell a put, and most of the time options contracts expire worthless. 75% of the time. I believe it might be higher than that for specific things. But that means that since they expire worthless, 75% of the time the seller wins. And so that seems to be true. We're getting better odds than that today. But all of these are sold puts. This is more of a defined. It's a put spread. So anyway, well, the whole point. Sorry, I'm getting sidetracked. But the whole point of this is, even if I lose, let's say the price comes down here, it's not a real loss, because what I end up doing is I spend the money I put in on 100 shares. So when you lose, you don't really lose. You get 100 shares. Now, the reason why it's so important to find stocks that you are comfortable with is because if you lose 25% of the time, you want to own 100 shares of a stock that you like. And I have a fundamental analysis method that I copied from Charlie Munger, what's his face, the most famous investor in the world. I literally forgot his name. I just was watching a video on him. But Charlie Munger's business partner, Warren Buffett. Sorry, obviously, Warren Buffett. So he has a fundamental analysis thing. That's his whole life. That's his whole style. And I use that to find companies I'm comfortable with. So I have higher risk tolerance than most investors, most dividend investors. So I'm more like a trader, but I treat all my trades like investments. And so I do that by analyzing the fundamentals of the company. Is it a good company? Do they have cash flow? Are they in debt? I'm okay if they're in debt as long as, the debts aren't due within the time period I'm going to use their stock to make money. So all that stuff, and you just need Robinhood to do this. So I'm going to make a course on that, although it might be a paid course, but almost everything, if not everything I do is going to be free. So, and for my friends. And anyway, so most of the time puts win because in general the market goes up. And I'm sure if you look into these companies, they're suspect, but time-wise, like this time frame I'm doing this in, they should be fine. And then Oatly is pretty good, and it's probably not going anywhere in general, which is this one. So I have a few plays on that. This is kind of a rare opportunity, the New York Community Bank, and I'm not sure. Maybe it's not as rare as it seems to me. Nicola. I know Nicola. I know the company. It's not that great. So I own 100 shares of it because it's so cheap. It's 74 cents. So I spent like $70 and got 100 shares. Let's see. Oh, I got it for $68. So I already got a total return of 9.8% on just buying it. And now I'm also running a covered call and a put. And the put looks good, but they're both negative, but I don't care because I can't lose on the top side. So for calls, when you do a covered call, it's the opposite side, right? So it's if the price runs up. But if the price runs up, I bought these shares for 68 cents. And if I end up losing this trade, then I'll sell them for $1.05. So I still win. And that's why the wheel is so strong, because the wheel means all your trades are unbeatable. Now, obviously, if the only real danger is if you run the wheel on a company that sucks and it goes bankrupt, because then you could lose. Because you'll have worthless shares, or you will, well, I guess if it runs up, you can never lose on covered calls. Well, anyway, so you can see why the wheel is the best idea. It's almost no risk if you run it on something like SPY. So there are ETFs that you could run this on. I'm just poor, so I can't do it on SPY. I can barely buy, like I don't know how many shares are worth, like $500. So I could buy 10 shares of SPY, and that's it. And that's 10 times too little. So essentially, you can't really run the wheel on these unstoppable underlying securities like ETFs or stocks. You can't really do it in that sense until you have 5 figures. So that's why 10,000 is such a big deal. Obviously, if you have 100,000, you could run it on a lot of different stocks because a lot of great companies are not necessarily super expensive. So anyway, that's what I'm doing. I'm still running King Mechanics and this is a King Mechanic trade that I made 90 days out. It's an April thing. And I have a few of the Tasty trades that are up, but I sold, and I'm doing puts and stuff. So yeah, I'm basically starting to favor individual stocks. And so the bad news is it takes a lot of work, and you have to understand a lot more about business, stocks, and how to fundamentally analyze companies. Or you could just find a list from someone you trust. And I have a couple lists that I might put together with the methodology of using screeners to find really good stocks and then check them with free resources like Seeking Alpha, free account, or Yahoo Finance, real account. So if you're interested in that sort of thing, let me know. But just let me know what you want to learn about the wheel, about naked puts, about covered calls, because everything I do is based on all these ideas, including fundamental analysis, which is what the Dragon portfolio is made of. There it is. And just credit where credit is due. I use almost all of my Dragon portfolio is in common with Joseph Carlson. He is a dividend investor, and a lot of his ideas are why I built the Dragon portfolio in the first place. But you can see these are all incredibly good companies. Maybe I should run puts on the cheaper ones. Didn't think of that, like Vici and Canadian Pacific and Union. Well, this is a little expensive, but yeah, maybe I could. Anyway, I think they're still too expensive for me. I can only afford single-digit things right now, but yeah. So there are 3 stages. There's 0 to 5,000, and then there's 5,000 to 10,000, and in that range, I'm looking at single-digit stocks. So anyway, keep it real. Hope you're doing great, and keep investing. Peace.